of gravity hit Wall Street today and financial markets around the world for that
Inflation
matter.
rate is worsening by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate.
Now, what would happen to your money if things actually got worse from here? We're seeing rising tensions in Iran, private credit markets showing signs of stress, and more people are talking about a potential financial reset. And if you're watching the stock market right now, you might be wondering, is this the beginning of something bigger? Because if history tells us something really important, not all market drops are created equal. Some drop fast and recover just as fast. Others take years to recover, and a few change the entire financial system. So in this video, we're going to break down what typically happens to the market during these geopolitical conflicts, what happens during real financial collapses, and how bad things could get if multiple risks stack together. And most importantly, how to position yourself so you're not caught off guard. So let's start with something that might actually surprise you. Now, most people assume war crashes the stock market, but historically, that's not usually the case. Data shows the average stock market drop during geopolitical events is just around 4 to 5%. And here's the most people don't know. Markets typically bottom in about 18 days and recover in roughly 39 days on average. That's barely over a month. Even recent data shows markets only fall 3 to 5% during conflicts, even with major headlines. And historically, many of these dips are followed by double-digit gains within a year. So why doesn't war crash the market? Well, because war is usually two things: short-term uncertainty and not a full economic breakdown. Well, unless it triggers something bigger. And that's where things start to change. But before we cover when a war actually causes a crash, I ask that you hit the like button down below and subscribe to the channel. It is 100% free and helps the channel reach more people so we can all get through this time together. So now let's get back to the video. Now, there are exceptions. The biggest one is when a war causes an energy shock. The perfect example of this is the 1973 oil crisis. That conflict didn't just create fear, it caused oil prices to spike globally. And then the market ended up dropping over 40% over time. But here's the key thing to remember. War alone doesn't usually crash markets, but war plus inflation plus energy shock plus a weak economy, now that's when things get really dangerous. And that's why the current Iran situation matters, because it's not just a conflict in a region, it's a conflict tied to a global oil supply. Now let's shift gears, because this is where things actually get pretty serious. When you look at actual financial crises, not just geopolitical events, the numbers are very different. On average, during recessions, markets tend to drop an average of around 25 to 35%. But let's look at real examples. The dot-com bubble of 2000 to 2002. From the peak of the internet stock frenzy on March 24th, 2000, to its low on October 9th, 2002, the S&P 500 fell 49%. The 2008 financial crisis. From October 2007 to March 2009, the S&P 500 plummeted near 57%. And it took more than 5 years for that index to recover. Now, the COVID crash of 2020. For the COVID crash, from the S&P 500 peak at the close of February 19th, 2020, to its trough at the close of March 23rd, 2020, just a month later, the S&P 500 fell by 33 to 34%. Now, other broad measures of U.S. equities also showed similar peak to trough declines. The Dow Jones reported a near 37% decline. Now, here's what separates these from war. These weren't just events. They were system problems. They were over-leverage, bad debt, broken financial structures. And that's exactly why people are talking about a private credit collapse, banking stress, and a possible financial reset. Now, with everything going on in Iran right now, one of the biggest risks that most people aren't paying attention to is private credit. This is money being loaned outside of traditional banks, often with less regulation, higher risk, and less transparency. Now, these stem from our inability to delay gratification. Private credit funds are created by professional investors who raise cash from a group of backers, they add leverage, and then they make loans to smaller companies. Now, they offer returns that are generally higher than those from traditional assets like stocks and bonds, but the flip side is that they can be harder to exit. And that's exactly what many are trying to do right now. But large fund managers have decided to limit withdrawals and redemptions, as these loans are, well, not as liquid as just selling a stock. Now, if banks started limiting withdrawals, this would surely cause a run on the banks, which would be devastating to our financial situation. And if enough of those loans fail at the same time, it can create a ripple effect similar to 2008. Now, this is why you're hearing more conversations about a potential financial reset, because resets don't just come from one event. They come from pressure building across a system. Now let's talk about what this financial reset would actually look like. It doesn't mean the system just disappears overnight. It usually looks like asset prices resetting lower, which is what we're seeing in the stock markets and in some housing markets across the nation. Debt being restructured or completely wiped out, which is what we're seeing with these private credit loans, and wealth transferring from over-leveraged positions to cash-rich positions. Leverage is the main risk factor right now. And historically, these periods feel chaotic, but they also create massive opportunity. Now, this is where things get encouraging. Even after the worst market years, markets tend to recover and grow over time. For example, looking at the worst market years since 1975, here are the average returns after a recession. 3 months after, 10%. 6 months after, 15%. 1 year after, 23%. And 2 years after, 32%. So even though the drops feel scary, the long-term pattern is very clear. Now that we have opened all of this, what should you actually do about it? Well, here's a simple breakdown. If it's just geopolitical tension, you just expect short-term volatility and not long-term damage. But if it turns into an economic showdown, expect deeper drops of 20 to 30%. Now, if it becomes a financial system issue, that's when you get these major resets and generational opportunities. So instead of reacting emotionally, you want to be prepared financially. Now, right now, I'm running an investing challenge right here on YouTube where I invest $100 every day the market's open, and I double it if the market shows a decline that day. Now, this helps lower the average price of each share of stock that I buy. So when we see the market rebound, hopefully my returns will be higher than if I just invested a little each day. Now, at the end of the day, the market doesn't reward the smartest people. It rewards the people who just stay consistent long enough. Yes, there may be volatility ahead. There may be uncertainty. But history shows something very clear. Every major downturn eventually becomes an opportunity. If you want to learn more about the accounts that you can use to invest, you can check out this video next. I'll see you there.